Chapter 18, Managerial Accounting Concepts and Principles. So way back at the beginning of, really the year, if you've had me throughout the year, we talked about the difference between financial and managerial accounting. And we focused on financial accounting and said that was accounting done for external users of financial information. Now, managerial accounting is an activity that provides information, financial and non-financial, to managers within an organization instead of externals. Now, when we say managers, we basically mean employees in charge of companies' divisions, like heads of marketing, IT, HR, C-suite level execs, etc. Okay, so for these people to do their jobs, they need more than just general purpose financial statements that are provided by the financial accounting system. So that's basically why we have this distinction and other type of accounting. So it's more specialized for those types of users of information. So the purpose of managerial accounting is to provide useful information to managers within the organization. Managerial accounting helps managers with three key tasks. First is determining the cost of an organization's products and services. So you will often hear it called cost accounting. Second, planning future activities. And third, comparing actual results to planned results. Basically, we planned this much, we got this much, what's the difference, why, how can we improve, that type of thing. So managerial accounting differs from financial accounting, obviously. This slide is a summary of some of the key differences. We obviously focused on the top one most when I talked about it earlier, but there you have a number of other differences. Fraud and the role that ethics plays in reducing fraud are a couple important factors in the actual operating of a business. Fraud involves the use of one's job, at least with respect to what we're talking about here, for personal gain through deliberate misuse of employers' assets. Here's, let's see, a couple examples. Theft of employers' cash or any other type of assets. This could even include like paper clips, overstating reimbursable expenses, so listing 5 nights at a hotel instead of the 4 that you actually stayed, etc. Payroll schemes where we're paying fraudulent people and cashing those checks out ourselves, etc. 3 factors must exist for a person to commit fraud, or at least we've categorized them as such. Opportunity, financial pressure, and rationalization. This is known commonly through academia and in practice as the fraud triangle. Fraud affects all businesses in some way and is almost always fairly costly. Alright, so this is just an idea of some of the different types of costs that we're going to classify. At the most basic level, a cost can be classified by how it behaves with changes in the volume of activity. So a cost can be classified as either fixed or variable. A fixed cost doesn't change when the volume of activity changes within a range of activity known as the relevant range. That is to say, if you looked at the entire lifetime of the activity, maybe yes, it would vary. But within the relevant range that we're considering, it's going to be fixed. Okay? Straight line depreciation on equipment is considered or would be considered a fixed cost. So variable cost changes with proportion to changes in the volume of activity. So sales commissions, as salesmen make more sales, you have to pay them more commissions. So that would be an example of sales revenue, sales commissions as a percentage of sales revenue for variable costs. Oftentimes we have, when we're trying to trace costs, we are able to do so with something that's called a cost object. It's a product, process, department, or customer to which costs are assigned. Direct costs are traceable to a single cost object. Indirect costs cannot be easily or at least in a cost-beneficially way traced to a single cost object. So it's hard to trace them to one particular thing. All factory or production costs are considered product costs. Those would be considered costs necessary to create a product and consist of direct materials, direct labor, and factory overhead. Overhead refers to production costs that are not direct materials or direct labor, so kind of a catch-all for everything else. Product costs are capitalized as inventory during and after the completion of the products. They are recorded as cost of goods sold when those products finally end up being sold. Period costs are non-production costs and are usually usually associated more with activities that are linked to a certain time period rather than completed products. Common examples of these types of costs would be salaries of sales staff, wages of maintenance workers, random expenses like advertising expense, depreciation of office furniture and equipment. Period costs are expense in the period when they're incurred, and usually fall into the categories of either selling expenses or general and administrative expenses. This slide just shows some of the different effects of product and period costs. It's important to understand that a cost can be classified using any one, or really a combination of three different means that we have described here. Understanding how to classify costs in several different ways enables managers to use cost information for a variety of decisions. Factory rent, for instance, is classified as a product cost. It's fixed with respect to the number of units produced and indirect with respect to the product. Potential multiple classifications are shown in this slide using different cost items incurred in manufacturing mountain bikes. Finished bike is the cost object in this case. Proper allocation of these costs and the managerial decisions that can be based on the cost data depend, if you want them to be done correctly, on the correct cost classification. The cost concepts described, though originally kind of fleshed out in the manufacturing world, are also applicable and used by service organizations. Companies with manufacturing activities do differ from both merchandising and service organizations. The main difference between merchandising and manufacturing companies is that merchandisers buy goods ready for sale, while of course manufacturers produce goods from materials and labor. Amazon.com would be a good example of a merchandising company, whereas someone like maybe Adidas, who makes shoes, clothes, other types of accessories, it would be considered a manufacturer, primarily. Direct materials are tangible components of a finished product. Direct material costs are the expenditures for direct materials that are separately and readily traced through the manufacturing process to finished goods. Examples of direct materials in manufacturing, or at least in manufacturing a mountain bike, include the tires, the seat, the frame, pedals, brakes, cables, gears, handlebars, etc. So direct labor refers to the efforts of employees who physically change or convert materials into the final product. Direct labor costs are the wages and salaries for direct labor that are separately and readily traced through the manufacturing process to the finished goods. Examples of direct labor in manufacturing a mountain bike include operators directly involved in converting raw materials into finished products. So this would be anyone who's doing welding, painting, forming, assembly workers who attach materials like the tires, seats, pedals, brakes, put all that stuff on the frames, etc. Factory overhead, which is commonly called also manufacturing overhead, consists of all manufacturing costs that are not direct materials or direct labor. Factory overhead costs cannot be separately or readily traced to finished goods. So all factory overhead costs would be considered indirect costs. These costs include such things as indirect materials, indirect labor, and other costs not directly traceable to the finished product. Indirect materials would be materials used in manufacturing that become part of a finished product, but are not clearly identified with specific product units. Well, that's kind of confusing. But often direct materials are classified as indirect materials when their costs are low. Some examples of this would be like the hardware, like screws and nuts used throughout the assembling process of the mountain bikes, the staples and glue used if you're talking about like a shoemaker, like Adidas. Basically, when we apply the materiality principle, companies sometimes decide it doesn't make economic sense to trace the individual costs of each of these types of materials to the individual products. For example, keeping some type of detailed record of the amount of glue we use to manufacture one shoe does not really yield beneficial cost beneficial results. Prime costs are expenditures that are directly associated with the manufacture of finished goods. These include both direct material costs and direct labor costs. Conversion costs are expenditures incurred in the process of converting raw materials to our finished goods or finished product. And again, these include both direct labor costs these include direct labor costs similar to the prime costs, and now a manufacturing overhead. So obviously the only one of these costs that fits into both categories would be the direct labor costs. Companies with manufacturing activities differ from both merchandising and service companies. The main difference between merchandising and manufacturing companies is that merchandisers buy goods ready for sale, while manufacturers produce goods by using materials and labor. The main difference in the balance sheets of merchandisers and manufacturers is the presentation of inventory under the current assets section. Merchandisers have one category of inventory, and it's just called usually merchandise inventory. Manufacturers are going to have three main categories of inventory, and these are called raw materials, goods in process, and finally finished goods. Manufacturers carry several unique assets, usually have three inventories instead of the single inventory that merchandisers carry, like we just mentioned. So these are those three categories. Raw materials would be like raw steel, sheets of wood, etc. These can be direct or indirect. Goods in process means any of these guys that have had any work done to them at all that are not finished yet are captured within goods in process, and anything that is been started and finished would, of course, and is ready for sale, would fall into that category. The main difference between the income statement of a manufacturer and that of a merchandiser involves the items making up cost of goods sold. This slide compares the components of cost of goods sold for a merchandiser with those of a manufacturer. In computing cost of goods sold, a merchandiser uses merchandise inventory, while a manufacturer uses finished goods inventory. A manufacturer's inventories of raw materials and work in process are not included in finished goods because those items are not yet available for sale. The manufacturer also shows cost of goods manufactured instead of cost of goods purchased. This difference occurs because a manufacturer produces its own goods, of course, instead of purchasing them already ready to go and ready to be sold. The cost of goods sold sections for both a merchandiser, in this case Telemark, and a manufacturer, Rocky Mountain Bikes, are shown in this slide so you can see what the differences are. The remaining sections of the income statement would be similar for both merchandisers and manufacturers. Although the cost of goods sold computations are similar, the numbers in these computations reflect different activities. A merchandiser's cost of goods purchased is the cost of buying goods to be sold, already completed. The manufacturer's cost of goods manufactured is the sum of all the direct materials, direct labor, and factory overhead costs incurred in producing products. In addition to income statements and balance sheets, manufacturing companies typically prepare additional reports to help managers plan and control the manufacturing process. In order to be able to understand these reports, we first have to understand the flow of manufacturing activities and costs. This slide shows the flow of manufacturing activities and the cost flows of those types of activities. When you look across the top row, you should be able to see the activities flow consists of materials activity, followed by production activity, followed by sales activity. The boxes below those activities show the costs for each activity and how costs will flow across the three manufacturing activities. Managers of manufacturing firms typically analyze product costs in great detail. This type of analysis is useful, or can be useful, I should say, to help managers make better decisions about materials, labor, and overhead in order to reduce the costs of goods manufactured, and ultimately the goal would obviously be to maximize the company's profits. The schedule of cost of goods manufactured is a separate report that a manufacturing company would put out to describe manufacturing activities. Sometimes this is also called a manufacturing statement, statement of goods manufactured, or some similar term like that. Whatever name is used, pretty easily identifiable, and its basic purpose is to summarize all the types and amounts of costs incurred in a company's manufacturing process. This is just an example of a cost of goods manufactured for the company we've been looking at, Rocky Mountain Bikes. It's divided into 4 parts: direct materials, direct labor, overhead, and then the part that summarizes the computation of cost of goods manufactured. So walking through the steps here, step 1, compute direct materials used. Add the beginning raw materials inventory of $8,000 to the current period's purchases of $86,500. This brings you to $94,500 of total raw materials that are available for use. Physical count of inventory shows $9,000 of ending raw materials inventory. If $94,500 of materials were available for sale, and $9,000 were left over, that means $85,500 were used in the period. Of course, in this case, that would mean that all raw materials for Rocky Mountain bikes ended up being direct materials. Step 2 is compute direct labor costs used. Rocky Mountain bikes had total direct labor costs of $60,000 for the period. This amount does include payroll taxes and fringe benefits. So step 3, compute total factory overhead costs used. The statement lists each important factory overhead item and its corresponding cost. All of these costs are indirectly related to manufacturing activities. In addition, period expenses, such as selling expenses, and some of the other costs not related to manufacturing activities, are not reported on this statement. Total factory overhead cost for the period is $30,000. Some companies report only total factory overhead on the schedule of cost of goods manufactured, and then they would attach a separate schedule listing individual overhead costs. Step 4 is to compute the cost of goods manufactured. In this case, total goods manufactured for the period are $175,500. The sum of direct materials used, direct labor, and overhead costs incurred. This amount is added to the beginning work in process inventory. This gives the total work in process during the period of $178,000. The physical account shows $7,500 of work in process inventory remains at the end of the period. We then compute the current period's cost of goods manufactured as $170,500. We get to this number by taking the $178,000 total work in process and subtracting out the $7,500 cost of ending work in process inventory. The cost of goods manufactured amount is also called, or can be called, net cost of goods manufactured, or cost of goods completed. This slide summarizes how product costs flow through the accounting system. Direct materials, direct labor, and overhead costs are summarized in the schedule of cost of goods manufactured. Then the amount of the cost of goods manufactured from that statement is carried over and used to compute cost of goods sold on the income statement. Physical counts determine the dollar amounts of ending raw materials inventory and work in process inventory. Then those amounts are included on the end of period balance sheet. Of course, this particular slide, we're only seeing partial reports to emphasize what we're talking about. That's all I have for this chapter.